Hello, I'm Frederick Bell, the CEO of Elemental Altus Royalties. We're a royalty company, fast growing with 10 producing assets, a portfolio of approximately 70 royalties. And every year for the last 5 years has been a record in terms of royalty revenue, and we expect 2023 to be another.
Frederick, good to see you. Thanks for coming on. Q2 update, but also want to talk to you about a recent acquisition, Arizona Sonoran's project is a good one and a good acquisition for you. But okay, give us those numbers for Q2.
So we had adjusted revenue of $4.7 million. So that's the highest quarterly revenue we've had. And when you add that to Q1, it gets us to adjusted revenue for the first half of 2023 of $8.5 million US, which is in the middle of our guidance range. And we had guided before at the start of the year to guidance weighted towards Q3, Q4, second half of the year. So I think puts us in a very good spot so far, continues to increase revenue as we go. And also importantly, I think as we build out the portfolio, that consistency in delivery that you show over time, that's what we've really tried to focus on.
Right, and just a reminder, in terms of the construction of that portfolio, obviously you want to get better and better and bigger royalties into the portfolio. But can you just talk about the sort of the structure as it sits today in terms of the profiles of the contributing revenue royalties now? You know, what are they bringing in?
So our two largest royalties are Caserones and Karlawinda. Karlawinda is an asset in Australia. It's run by Capricorn, multi-billion-dollar operator, and Lundin operate the Caserones mine in Chile. And those two are our largest royalties, and they contribute a bit over probably half of our revenue. So those really underpin it. And then we've got another additional, at the moment, approximately 8 royalties, and those are producing from Mexico to Chile to, I think, various countries in West Africa as well, but it's pretty diverse in terms of the portfolio. Australia is our biggest weighting. So it is quite a diverse portfolio, and that is part of the reason we were able to upgrade our credit facility at the beginning of the year to a credit facility with the big banks, CIBC and National Bank. It was the quality of that portfolio and the diversified nature of it.
Right. Okay. And that's exactly where I wanted to go, actually, because, you know, as you're kind of moving through the phases and, you know, in terms of increasing and improving the kind of quarterly numbers, you're moving towards that 20 million revenue number. What does that allow you to do with regards to the credit that you've got available to you in terms of the cost of that capital, the volume of that capital, and in terms of any kind of covenants, etc., based on where you can allocate that capital?
Well, you've seen it so far this year already, and we've done a number of royalty acquisitions. We bought a further part on the Caserones royalty, and we did a third part on the Caserones royalty. We bought royalties on Hope Brook in Newfoundland and on the Pickle Crow asset, and then we topped off another third-party royalty on the Pickle Crow asset. And then we have just announced the acquisition of a royalty on Arizona and Sonoran's Cactus project in Arizona. And we're acquiring that from RCF, who are becoming a shareholder as part of that as well. So I think for us, it has been consistently acquiring new assets over the course of the year, assets that are both going into immediate revenue producing assets and build that diversification and that revenue base, but also assets that are coming into the pipeline. And our development pipeline has been something.
No, I know, and I do want to talk about Arizona Sonoran. Like I say, it's a good management team, you know, good asset, and you know, and meaningful in size. But I just want to talk about that risk profile. You know, not just how you view it, but perhaps how we should view that. So, in terms of that availability of credit, are there any restrictions on where you should go? We're all conscious of jurisdictional risk. It's a very sort of, you know, very topical, we'll frame it at the moment in terms of, you know, where companies, you know, perhaps are benefiting from, you know, the jurisdiction and others which perhaps are suffering a bit. We're looking at Niger most recently, you know, even a little bit in Mali. There's that sort of nationalistic conversation over there, socialist conversations in South America. So first of all, does the money ask you to manage and temper your risk appetite according to what they feel, or are you allowed to manage and make those decisions on yourself? And therefore, what should we read into that as a result? So risk, I guess, is the question.
I think the critical aspect for us is we are so well diversified across jurisdiction. And so Australia is our biggest weighting, but we've had producing royalties in Chile, in Kenya, in Burkina Faso, in Cote d'Ivoire, in Mexico. And we haven't just had it even in places like Australia where we're so heavily weighted. It hasn't all been in West Australia. It's been spread across as well. So that has been really helpful because it's the caliber of the operator and the counterparty. It's the diversified, I think, jurisdiction risk. And it's also the sort of balance of revenue in the portfolio. And I think it's important to, as well, highlight that even if you had all your assets in British Columbia, or even if you had all your assets in West Australia, tier 1 jurisdiction, you still have some regional risk. And I think you've seen that recently with the very sad forest fires in British Columbia. You've seen it in the last 2 years in Australia, in West Australia in particular, during COVID, when a lot of mines had issues getting trained staff and equipped staff. So I think that diversification works very well across countries. And I think the second point this is more of an internal one, but the way we've looked at it internally is that often in emerging jurisdictions, you can get better access to projects that are less explored. And often if you look at assets in Canada or Australia, they have already been mined for 5 years or 10 years, and they're moving maybe open pit to underground. Our key royalty in Australia, Karlawinda, is different. It is a brand new mine, but often that is the case. Whereas we would quite like some of the projects we see in South America and emerging mining jurisdictions in West Africa, where we see projects that are far less explored and they have got a decade of exploration ahead of them. And we really like the exploration upside. So if we can balance that exploration upside with the jurisdiction, high quality jurisdiction and producing assets that we have in key countries, that has been a very good, I think, blend for us so far. And we'll keep trying to do that as we go forwards.
Right. Okay. So that blend or amortization of risk across the portfolio is really important. So, for instance, okay, let's get into the Cactus project at Arizona Sonoran's with their project. I should say. What encouraged you to do the deal with these guys? What did you like about what you saw?
Well, we've been following the company and project for a while, and as they've advanced the both permitting and the exploration, and also I think the planning around the PFS that is due out next year. And for us, there aren't many high quality, advanced stage copper projects in jurisdictions like Arizona. So this was a very high quality opportunity. It was a really good fit for us. And in terms of the counterparty we're buying the royalty from, RCF, they're coming in, and I'm sure a lot of listeners know RCF, but one of the big private equity funds in mining, they're coming in as part of this acquisition, and taking the entire consideration in equity and becoming a bit over 5% shareholder, which was their election. So I think for us, on both of those counts, we're getting another really good shareholder, very knowledgeable in the mining space. We're getting a high quality copper development asset. It's adjacent to Ivanhoe. Rio are a major shareholder. It's, I think, the PFS that comes out in Q1 2024 next year will be a stepping stone for them, and a material uplift. So for us, that's really good. And I think just stepping back at a high level, we saw a lot of upside on the project, and we saw a lot of avenues for the asset to be able to add value. And that was an asymmetrical risk profile on this one.
So RCF not going to stepping away from this. They want to continue to be involved. So you've taken this opportunity. What next, right? We talk about, you're kind of moving through the phases. Like, it's nice accretive growth, steady growth to the bottom line revenue. That's quite frankly how you are judged or should be judged in all of this. And obviously the annuity stream of that cash coming in. What next for Elemental Altus Royalties? How do you continue to grow? Is it just more of the same, or does this give you a taste for slightly more aggressive future, or is the market not quite allowing that at the moment?
I think when you say steady, I think when you say steady growth, it doesn't feel like that internally. I think this is our fifth royalty acquisition so far this year in 8 months, and at the same time we have sold, partnered 2 of our major projects in Mali and Ethiopia. So we've done 7 transactions in 8 months, on the back of a merger between Elemental and Altus, and a new credit facility. There has been a lot going on, and I think there continues to be a lot going on. If you go back to our interview from probably earlier in the year, we thought that 2023 was going to be a very busy year for us in terms of acquisitions and developments in the portfolio. And I think we continue to see that in H2 for the rest of the year. So it is a lot of it is market driven and opportunity driven. And if you look at the company in 2021 and 2022, we were relatively quiet on the acquisition front. And by comparison, this year we have been incredibly active and will continue to be. And the other point I think I would add is, and it's an important one, is we've been able to do some of these transactions using, this is a second transaction this year, using equity, where the vendors are taking equity in us. And some of the transactions we've done, we've actually been able to maintain our cash balance at around $10 million at the moment. So as well as available funds on the credit facility, we still have about 10 million because we've been cash flow positive. And so we've been able to reinvest that. And that in itself, the fact that we don't need to raise money to pay the bills and keep the lights on, that in itself has been a factor in being able to bring people in equity in the story. Because they can see the upside and they know that if we're raising money, we're doing it to do a new acquisition.